In today's episode of the Daily Brief, I'll talk about three big stories. I first talk about how Indian households spend their money. I then discuss how Adani will self-finance its Colombo port project. And finally, I will talk about Google's new quantum chip, Willow. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host, Kashish Kapoor. Today is Thursday, 12th of December. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the show notes. So let's begin. On to the first story. How does India spend as a household? Do you remember how your family spent money 10 years ago and how it's different now? Chances are your expenses have changed a lot. Maybe you're spending on things that didn't even exist back then. Or maybe your lifestyle and priorities have shifted as you're better off financially now. This is true for every household. But we wanted to go beyond just thinking about it. We wanted numbers because, as the saying goes, in God we trust. All others must bring data. So we dug into household expenditure data from the MOSPI, that is Ministry of Statistics and Program Implementation, spanning 2012 to 2023, to see how the average Indian family's spending patterns have evolved. And here is what we found. The first thing we wanted to check was whether Indians are spending less on food as they've gotten richer. Or at least that is what we would like to believe because of the rising per capita GDP. There's a well-known economic principle called Engels' law that explains how household spending patterns shift with rising income. It states, as household income increases, the proportion of income spent on food declines, even if the absolute amount spent on food rises. It makes sense, right? As people earn more, the relative chunk of their income spent on necessities like food shrinks, even though they might spend more in absolute terms. But here's the thing, this doesn't seem to be happening in India, according to the MOSPI data. Over the past 10 years, Indians have been spending about 28 to 32% of their household budgets on food, with no big changes. Compare this to countries like the UK or the US, where Engels' law played out quite clearly in the last century. As income rose, the proportion of spending on food steadily declined. So why is India an outlier? There could be multiple reasons. Here are few. First, it's too soon to tell. A decade might not be long enough for an economic principle like this to fully play out. Second, it's about uneven income growth. While India's per capita GDP has gone up significantly, that number doesn't show how the wealth is distributed. If the top 10% of earners are pulling up the average while large chunk of the population hasn't seen much income growth, many households could still be spending a big portion of their income on food. And finally, the third point. According to Periodic Labour Force Survey, that's PLFS, from 2017-18 to 2022-23, the nominal average income for workers grew at just 2.2%. With real earnings actually shrinking, households had to compensate by increasing the number of working members by 3.4%. The result, household income grew by just 5.7%, barely keeping up with the rising cost of living. This goes against the basic assumption of Engels' law of rising income. Well, that aside, moving on, when we looked closer at the subcategories within food and beverages, some interesting patterns emerged. Ones that hint at how much more health-conscious Indians may have become, though there is evidence against it too. Spending on meat, fish, and seafood has gone up, while spending on dairy and poultry products has stayed steady. This shift suggests that Indians are opting for more protein-rich foods, while traditional staples like bread, cereals, and pulses are taking a backseat. These staples, while calorie-dense, often lack the nutrient profile of a protein-heavy option. One possible explanation for this trend could be the public distribution system in India. The PDS has likely reduced the relative spend on staples like cereals by providing them at negligible cost, freeing up budgets for other nutritional priorities. Another positive trend is the drop in spending on sugary foods. Although sugar cannot be completely cut off from diet, this is good to see. The proportion of household expenditure on sugar, jam, honey, chocolate, and confectionery has fallen from 4.95% to 3.05%. But this couldn't stop India from being the diabetes capital of the world. One reason could be that this data doesn't account for all the processed and junk foods we consume outside our homes, in restaurants, cafes, and on the go snacks. Even alcohol and tobacco, which people usually spend on steadily, haven't grown much. Spending on alcohol went up by just 7% per year, and tobacco by 5.5%, while overall household expenses grew at a much faster rate of 11.5%. In short, people are cutting back on these indulgences compared to before. But the real twist comes when we look at the pre and post COVID impact. Before COVID, tobacco was growing faster than alcoholic beverages. But post COVID, tables have turned. Spending on alcohol actually shot up, while tobacco actually witnessed degrowth. Why the sudden shift, you may ask? It seems that COVID may have flipped a switch in consumer mindsets. Alcohol may have become more socially acceptable, with home consumption and social drinking gaining traction during lockdowns. Meanwhile, tobacco seems to be villainized right now, possibly due to heightened health concerns during the pandemic. But it's hard to point at exact reasons for what is happening. Now, spending habits don't just stop at food. Let's dive into other areas where data reveals surprising trends. Have you noticed how people are spending less on manufactured goods and more on services these days? Stuff like healthcare, education, transport, communication, even recreation are taking a bigger chunk of household budgets, while spending on things like clothing, house amenities, and consumer goods is starting to shrink. It makes sense though, right? People now see services like education and health as investments and are prioritizing experiences over buying stuff. It's a cool shift that says a lot about how our lifestyles are changing. Now let's zoom in on some micro level insights from data because the little details tell us big stories. First, footwear took a massive hit during the pandemic. With everyone staying indoors, demand plummeted, and post COVID, growth has been almost zero. But this seems to be changing. Starting in 2024, we are seeing footwear companies going big on trends like premiumization and athleisure, a topic we covered in a previous edition of the Daily Brief. Number two, people are ditching old school fuels like liquid fuels, which is kerosene, and solid fuels, which is charcoal and firewood, while LPG is clearly taking over kitchens across the country. This shift reflects the success of initiatives like Pradhan Mantri Ujjwal Yojana, which subsidizes LPG and promotes its adoption. The result, a visible move towards cleaner and more efficient cooking fuels across households. Number three, vehicle sales bounced back after COVID. Before the pandemic, sales were slow, but they picked up afterward, hitting all-time highs. This shows how people pent-up demand after lockdown boosted spending on vehicles. Number four, household spending on insurance has grown at double the rate since COVID. And it's not hard to see why. The pandemic changed how people view insurance, from just being a tax-saving tool or a pseudo-investment vehicle to something essential for financial security and protection. COVID was a wake-up call, and the data shows people are now prioritizing insurance as a core part of their household budgets. Now, before we wrap up, here's a quick disclaimer. If you've been following the news, you might notice that the observations from the MOSPI data differ quite a bit from the findings in the Household Consumption Expenditure Survey, that is HCES, which made the headlines back in September. Now, why the discrepancy? Well, there are several reasons. It could be due to differences in definitions, methodologies, or even conceptual approaches. For instance, how a household is defined or how expenditures are calculated can vary significantly between these two things. Also, let's not forget that HCES was a survey of 2.5 lakh households, while RBI data from the National Account Statistics 2024 is a modeled estimated figure. Naturally, this leads to differences in outcomes. So while the data we shared is insightful, it's always good to take it with a pinch of salt and keep these differences in mind. And there you have it, how our spending habits have shifted over the years. But this is just the big picture. What about you? Have you noticed any changes in your spending habits over the last decade? Are you spending more on experiences than things? Or maybe cutting back on something you once considered essential? We'd love to hear your observations. Drop a comment and let us know how your priorities have evolved over time. After all, these individual stories are what make the bigger trends so much more meaningful. And now on to the second story. Adani Group has decided to back out of a $553 million loan deal with the US International Development Finance Corporation, that's TFC. This money was meant to help Adani fund the construction of the Colombo West International Terminal, that's CWIT, in Sri Lanka. The project was seen as a big step in countering China's dominance in the Indian Ocean. Instead of using the US loan, Adani now says it will pay for the project itself using its own funds. This decision comes as Gautam Adani, the group's founder, faces bribery allegations in the US, which has created a lot of uncertainty around companies' international projects, something we discussed earlier in the daily brief as well. Let me give you some context on why the hell did the port deal matter in the first place. The Colombo port is one of the busiest ports in the Indian Ocean. It handles a significant share of India's transshipment cargo. Some estimates suggest close to 45%. Transshipment, in simple terms, is the process where large container ships offload their cargo at deep water ports like Colombo. From there, smaller ships distribute the goods to ports that can't accommodate the bigger vessels. Colombo's deep water capacity makes it an ideal hub for this process, especially since many Indian ports can't handle these massive ships. The CWIT project is led by a joint venture where Adani Ports owns 51%. The remaining 49% is split between John Keel's Holdings, one of Sri Lanka's largest conglomerates, and the Sri Lanka Ports Authority. The US had initially stepped in with its largest ever infrastructure investment in Asia, offering $553 million in funding. This was part of a broader strategy to push back against China's influence in the region, as China already controls significant stakes in other Sri Lankan ports. But it looks like the deal collapsed because of the allegations against Adani. In November, Gautam Adani and some of his top executives were accused of paying $250 million in bribes to win solar contracts in India. While this had nothing to do with the Colombo project directly, it made the US government cautious. The DFC said it was still reviewing the project and hadn't finalized the loan, but the whole process seemed to have slowed down. The US pulling out does raise some questions. The DFC loan wasn't just about money. It was about the US showing its support for reducing China's influence in the region. Without the backing, the project loses some of its geopolitical significance. This story isn't just about one more port, it's about who controls the Indian Ocean. And for the final story, Google announced a groundbreaking new quantum chip called Willow, and Sundar Pichai hailed it as a major leap forward in computing. He said, and I quote, "Willow is paving the way for solving humanity's toughest challenges by harnessing the power of quantum mechanics." Now that sounds impressive, but honestly, we couldn't understand a single thing about what it actually does. So we did what anyone would do. We asked ChatGPT to dumb it down for us and write a script. If you like the story, it's because we did a great job at asking ChatGPT the right questions. If the story doesn't make any sense to you, it's all because ChatGPT did a bad job explaining it to you. So here it goes. Willow is a fancy new computer chip built for a type of machine called a quantum computer. Unlike your regular laptop or smartphones, a quantum computer is designed to solve ultra-complicated problems that our current computers can't handle. Think of it like the brain of a next-level machine, a machine so advanced that it could one day help discover new medicines, create better renewable energy systems, or even tackle climate change. Sounds cool, right? But here's where it gets very tricky. Quantum computers don't work like regular computers at all. Now you may ask, why are quantum computers so different? Let's start with the regular computers, like the one you're listening this on. These use bits, which are the smallest units of information. A bit is super simple. It's either on or off. That's 1 or 0, like a light switch. All the amazing things your computer does are built on these ones and zeros. Quantum computers, however, use something called qubits or quantum bits. A qubit is like a magical light switch that can be on, off, or both at the same time. This weird phenomenon is called superposition, and it lets quantum computers process many possibilities simultaneously, making them incredibly powerful. But there's a catch. Qubits are super fragile. Even a tiny disturbance like a bit of heat or a vibration can mess them up, causing errors. That's been the biggest challenge with quantum computers so far. Here's where Willow comes in. Willow is like the superhero of quantum chips because it's really good at handling those pesky errors. It uses a technique called quantum error correction, which keeps qubits stable and reduces mistakes. Even more impressively, Willow doesn't just fix errors. It gets better at fixing them as you add more qubits. Imagine building a team where every new member makes the group work smoother and faster. Well, that's Willow for you. And speed. Willow performed a calculation in 5 minutes that would take today's fastest supercomputers 10 septillion years. To put that in perspective, the universe itself is only 13.8 billion years old. Yeah, it's that fast. So what's the point? Okay, Willow is fast and less error prone, but how does that help me or anyone else in the real world? Turns out the possibilities are massive, like discovering new medicines, Quantum computers can simulate how molecules interact, speeding up drug discovery by decades. Number two, better batteries. They could help design batteries that last longer for electric vehicles or store renewable energy more efficiently. Number three, fighting climate change. By simulating complex weather and climate patterns, quantum computers could help us predict and mitigate environmental changes. Number four, supercharging artificial intelligence. Training AI takes an enormous amount of computational power. Quantum computers could make AI smarter, faster, and more efficient. And finally, finance and business. Banks could use quantum computers to analyze risks and predict market trends far more accurately. Willow isn't going to be in your next smartphone or laptop. It's more like a proof of concept, showing us what's possible in the future. Think of it like the Wright brothers' first flight. It wasn't carrying passengers yet, but it proved that flight was possible. In the same way, Willow is showing us that quantum computers can actually work on big scale and tackle the kind of problems we thought were unsolvable. We're not there yet, but Willow is a huge step forward, making that future a reality. If Sundar Pichai's announcement felt like a jargon overload, I hope this explanation clears things up. Now, disclaimer, this was what ChatGPT taught me about Willow, so don't judge me or my team for any mistakes. Finally, on to the tidbits for the day. First, Amazon is set to disrupt India's quick commerce market within 15-minute deliveries in Bangalore, challenging Swiggy, Instamart, and Flipkart. Leveraging its infrastructure, Amazon aims to redefine delivery standards in this $3.3 billion market. Second, Tesla is reviving plans to enter India, exploring showrooms as the EV market is projected to grow to 30% by 2030. With reduced import taxes and rising EV demand, Tesla's entry could redefine India's luxury EV segment. And third, China's export grew by just 6.7% in November, down from October's 12.7%, while imports fell 3.9%, the worst in 9 months. Weak global demand and internal challenges prompt Beijing to plan aggressive fiscal measures for 2025. And that's it for today. I'm your host Kashish Kapoor. This was the Daily Brief, and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.